IT bellwether Infosys has kick-started the earnings season with strong and robust set of numbers. What is the way forward for the company and what will dictate the script of 2014? Global recovery or anemic growth? To understand that, to discuss that, I have with me the CEO of the company, Mr. Shibulal, along with him Sandeep Dadla, Head of Retail in Americas, and we've got Ravi Kumar, who will give us a flavor of the insurance business. Gentlemen, thank you for joining us. Happy New Year to all of you.
Happy New Year to you.
Shibu, Q3 is seasonally a weak quarter, but you managed to deliver. You've increased your guidance. Margins have also gone up. Tell me the secret sauce. What has worked for you?
I think Q3 was a fairly decent quarter as per our expectation. As you said, generally Q3 and Q4 are soft quarters. Q3 predominantly because of holidays and furloughs. We had fairly okay growth, 1.7%, but the other numbers look better. Our margins, our growth margin has gone up from 35.3% to 36.1%. Our operating margin has gone up by 1.5%, 23.5% to 25%. Our client additions have been strong, 54 new clients added. Number of million-dollar clients, new 26 million-dollar clients have been added during this quarter. Not added during this quarter, over the last 12 months, we have added, as of now, another 26 million-dollar clients. So overall, a decent quarter.
For the first time after a gap of 3 years, I've heard you use the word excited. You never used this word last year. You never used this word when Infosys was growing at the rate of about 9 to 10%. So can I read in between lines that FY15 will be a better year?
I used the word decent, not excited.
We are excited for the prospects going forward. That's your first line of the press release.
The future is always, we are always optimistic about the future.
Okay, markets are raising eyebrows. Some analysts are worried. 8 exits in 6 months. What's going on?
So I think we need to put this in perspective. If this is a large corporation, 160,000 people. Even if I assume that we have 1% of the people as leaders, that is 1,600 people. So this is a very few. Actually, we are focused on a very few exits. It is a large corporation, and large corporations, when they undergo transformations, these are expected to some extent. Some changes are expected. Also, our leaders are very strong leaders. They are strong people. They have aspirations, ambitions. And some of them would have larger aspirations. So, and again, I go back to what I said. One needs to look at this in perspective. We are a very large corporation with a very large leadership pool. Even if I take 1%, it is 1,600 people. I don't think we should be overly focused on a few of them.
So this will not lead to any kind of a business disruption?
Actually, the answer is clear no, because as you can see, we have been able to do the transitions very, very quickly and seamlessly. Of course, at the time of transition, any leader, at the time of transition, there will be some inconvenience, right? Because it has to be transitioned, the next person has to be identified from the large pool which is available, but we have done all that. Also, our client relationships are multi-level. It is not a single point client relationship. So that allows us to continue our strong client relationships, even if one person in that chain of relationship steps out.
Fair point. One thing which is puzzling me and a lot of your shareholders and analysts who track you is that you expanded the executive council in October, you've decided to disband it. Why do you think this lean structure will work, and what was the need to dismantle the executive council?
So I think there are two parts to this story. The executive council is the highest level deliberating body in the organization, and we expanded it so that a wide set of people can be part of the deliberations. We have now announced 2 presidents. Most of the business portfolio is going to transition into those presidents. One of them predominantly focusing on global markets, the other one predominantly focusing on global delivery, which means they will now start set up their own governance processes. That is why we have disbanded the higher level executive council as of April 1st. The new presidents will set up their own governance processes.
So is this the final structure now?
At the highest level, it is the final structure, 2 presidents at this point in time. The transitions into them is still in progress.
So middle level we could hear more exits?
Middle level we could see transitions.
Okay, fair point. Sandeep, tell me a bit about the retail business, because what we read in newspapers about the average American retailer spender, the news is not bad. Is that bad news for you? Is that an opportunity for you?
Well, the holiday season just got over in Americas, and we saw that the retailers had the odds stacked against them. They had a late start to the season. They had intense promotional activity, so retailers had to really discount heavily to get consumers into the store. They also had logistics issues in the end. They had credit card fraud playing up, etc. Overall, we saw holiday spending go up by about 2%, which is marginal. But the good news, if you double click into that, was that online spending went up by 10%. Spending on mobile devices went up by 40%. So what does that mean to us? It means that retailers had to reduce margins, so they will continue to undertake ruthless cost optimization exercises. Even in this quarter, retail and CPG grew at about 4.1%, which were included in that was a couple of large deal wins. That was a classic example of a large cost optimization initiative from a couple of retailers, where we could take advantage of that. On the other hand, spending will go up in select areas. In this holiday season, we were supporting 6 retailers in unique functionality like buy online, pick up in store, buy online, return in store, all kind of multi-channel functionality as part of the digital transformation. Investments in digital transformation, BI and analytics, we expect that to go up intensely. So it's a mixed bag. We will have to look at the short term and continue to take full advantage of their cost optimization initiatives and their increase in select areas in discretionary spend.
Ravi, the rebid opportunity is a big opportunity for any IT company which has presence in the insurance business. Tell me a bit about the rebid opportunity.
Sure. So, just to lay the broad landscape, insurance is a high-spend technology vertical. At this point of time, the budgets are stable to flat, and there is an upward bias in a few areas. Rebid is a great opportunity. In fact, every insurance carrier goes through a refresh cycle of the service providers, and obviously we are targeting those refresh cycles. Places where we are incumbents, we'll try to hold on to it, and places where we are not incumbents, we will try to grab the wallet share there. The 2 or 3 areas where spend is very high in insurance is driven by business drivers for insurers. Insurers are going global because some of the economies are getting deregulated, so they're taking systems and processes global. So when they rebid, they're also looking for an extension and an upgrade to systems which are global and processes which are global. Some are going digital. There is a fair bit of apprehension that the average per capita spend, say in life insurance, is going down. So you have to capitalize on the Gen Y and the broader demographics. So insurers are spending money there. Insurers are spending money, interestingly, in business intelligence and big data for core risk management. So just to summarize what you just asked, rebid opportunities are coming with the legacy modernization as well as with a set of incremental opportunities which I just spoke about. And interestingly, smart insurers, what they're doing is they're optimizing their business ops, taking the money out and spending on these areas.
So if you have to translate 2014 into what it means for IT budget, what's your take, Shibulal?
So the budgets are getting closed timely. We are expecting that the budgets will be stable. At the same time, our clients are very much focused on cost optimization. So that does give us an opportunity to create solutions which will reduce their total cost of ownership. But we are also seeing different trends in different verticals. But overall, we are expecting that the budgets will be stable.
When you say stable, you don't see a marked improvement in that?
We don't expect a marked improvement in that. Some sectors there may be an improvement, but some other sectors there will be a decrease. So we expect it to be stable.
But you've given a sort of medium-term outlook on margins. You expect the medium-term margins for Infosys to stabilize in and around 25%. What's the assumption behind that? Because you've never made such a statement in the past.
No, I think the assumptions are based on some of the transformations which we have done in the cost side. Some of the cost optimization initiatives which we embarked on over the last 6 months have paid dividends. It is too early, but they have paid dividends, and there are early indicators that they will work. So based on those factors, we have given a medium-term 25% margin number.
Do you think pricing power is also coming back, or pricing power is still coming back at a cost?
Actually, pricing is stable. Our revenue productivity went up by 0.7% this quarter, actually 2.2% and 2.2% on-site and offshore, but blended at 0.7%. While the pricing is stable, the large outsourcing deals are very, very price sensitive. And they continue to be price sensitive.
Do you think the CEO race is now just reduced to 2 horses? Are you still open to an external CEO?
I think that is a question for the nomination committee.
But you're still open to an external CEO?
That's a question for the nomination committee.
Broadly speaking, Rohan Murthy's role is completely carved out. But after he joined Infosys, we've seen a restructuring happen within the organization. Will his role still remain status quo?
I think this was clearly answered by Mr. Murthy when Rohan came in.
That was 6 months ago, sir.
I think that's the same answer.
Okay, a personal question. 2 of your colleagues have joined politics, Nandan and Bala. After 2015, are you thinking on those lines?
You should never say never to anything in life.
So you open to joining a political party?
Should never say never to anything.
To talk about margins, what is happening to specific cost-cutting initiatives, which way things are headed for the manufacturing vertical, and which are some of the key new growth markets Infosys plans to focus on. We are now joined by the CFO, Rajiv Bansal. Along with him, we've got Deshjit, head of growth markets, and we've got Sanjay Jalona, head of global manufacturing. Happy New Year to all of you, and thank you for joining us.
Happy New Year.
Rajiv, you've done it. Operating profit margins at 25%. You told us this was coming. Is it here to stay?
No, as I've been saying in all my earlier interactions with investors and with media, I think I would believe that the margins in the medium to long term would be around 25%. However, you would continue to see quarterly fluctuations depending on our need to make investment in the business. So I think in the short run, you would continue to see fluctuations in our margins. But in the medium to long term, I think margins are here to stay around 25%.
Are you also considering some kind of wage pressures? Because there is a buzz in the market that Infosys could consider a double-digit wage hike.
I really don't know what the market is talking about, but I think we still haven't worked out our numbers as yet. I think first we need to put our plans for next year in place. We need to look at where our revenues are likely to be, what our cost structures are going to be, and then comes about decisions to what wage hikes we're going to give.
So no double-digit wage hike?
No, I'm not saying yes or no. I think it's too early in the day to talk about wage hikes. I think but one thing which I would add, we want to pay our employees well. I think we believe that they are the biggest assets we have in the organization. We have to pay them well. We have to pay them what is due to them in terms of their bonuses, variable pay structures, and whatever we have. So over the last 12 months, we have made significant changes. We've brought down the variable component, we've increased the fixed component, we've given wage hike, we've increased the variable payout. So I think we are doing all things, but I think how much of it we can do how much further we can do over the next year would depend on when we put our budgets in place.
And when will you decide that?
Typically the budgets would get frozen towards February, March. So I think when we start our new financial year, we'll have the budgets in place.
I want to understand about your utilization rate, because your utilization rate is the lowest in the industry. Growth is coming back, which clearly is going to help your utilization rate improve. If a utilization rate goes up by 1%, how will that boost up your margins?
Typically we see about 50 to 60 basis points improvement in margin for every 1% improvement in utilization.
So where do you think your utilization rate is headed?
I think I would want the utilization to be about 80 to 83%, and that is what I am putting in the operations plan as we speak. But I think we also have to look at, when you see growth coming back, I think it's important to keep the utilization slightly low, because you can take advantage of every opportunity which comes in your place. The cost of maintaining a bench offshore is very low compared to the opportunity loss that you're going to see if you don't have enough people. So I think when you see growth trajectory, then I think it's important to keep the utilization around 80. But on a stable environment, I think 82% is the right utilization level.
Jit, I want to understand about the new growth markets, because that's a very broad definition. Typically, Indian IT companies, they always tend to focus on US, Europe, and Australia. You plan to focus on emerging markets and China. Tell me a bit more about it.
Right, okay. So when we say growth market, it is essentially Asia Pacific, Middle East, and Africa. And we have about 6 clusters. One is Australia, New Zealand. Another is India, Japan, Greater China, consisting of mainland China, Hong Kong, Taiwan, Macau. Then Southeast Asia, Singapore, Malaysia, Philippines, Indonesia, these countries. The other one is Middle East and Africa, which is essentially Saudi Arabia, UAE, and South Africa. These are the 6 clusters we have. What we want to do is that we want to provide undivided attention to these markets. That's a very, very important, and it's needed for these markets. And we want to come much more closer to our customers, intellectually, socially, and intellectually, socially, and
But you really want to help
culturally.
them out.
Intellectually, socially, and culturally. That's a very, very important aspect.
Are these big markets? And
Oh,
do you think
absolutely.
they are big markets? Do you
If you look
enjoy
at
the same margins there?
Oh, absolutely. Yeah. For example, if not necessarily in all places, but as a whole, I think we have a comparable margin. Australia will get a higher margin. Japan also will get a higher margin. Other places it's picking up right now. So that is the situation. These are very, very small right now. But I think we believe that these are the real growth market, and by having real focus, by focusing on the customer, as I said, it has to come closer to the customer, intellectually, socially, and culturally, which is very important. We believe that we can add much more value by understanding the customer, their needs, which are explicit as well as implicit. Thereby, we can actually use our own solutions, which have to be customized for this market, and offer solutions.
Sanjay, the world is clearly divided on when will growth come back, and if growth will come back, will it come from capex-oriented businesses? Will it come from manufacturing-driven practices? What is your sense? Do you think genuine growth is back for the businesses you had?
So it's a mixed bag overall, but there is definitely a positivity.
Mixed bag is always the easiest answer.
No, I'm going to take a side. I'm going to give you more on that. So the reason why I say it's a mixed bag, because let's talk about manufacturing. Manufacturing is made up of 5 subsectors. You have automotive, where they are having record sales. There's a lot of investment going into automotive. Their budgets are high, and everything is working very well. Look at aerospace. Aerospace, the commercial side is doing well. They have record order bookings, and there's a lot of pent-up demand. But on the defense side, anybody who services the defense industry, the government is not spending money there. So that puts pressure on the commercial side. You look at industrial manufacturing. Mining sector is down, construction is down, China is down, as you know. And that puts pressure on the mining sector and the construction sector, also on the industrial manufacturing companies which are servicing and producing equipment for mining industry. So and high-tech overall is positive for anyone who's working on the tablet side or smartphones. But anybody who's on the PC side, it's very sluggish. That's why it's a mixed bag. Automotive very strong, aerospace commercial very strong, industrial mid, high-tech, barring PC providers, PC industry, it's very robust. That's what I meant by mixed bag.
Rajiv, last time when we interacted with you, you told me the business confidence index had gone up from 5 to 7. Has it gone from 7 to 8 now?
No, I'll say still at 7. Our increasing the guidance to 11 to 12%, 11.5 to 12% that we're given now is basically a reflection of what we achieved in the first 3 quarters and what we expect to achieve in the 4th quarter. But I would say it's still at 7. It's still early days. I think once we get the budget closures from the client and we put our plans for next year, maybe this you could ask me next quarter and with no way.
Fair point, but your guidance for FY14 accounts for a flat growth for this quarter. Why is that? Because Q4 is not a seasonally weak quarter. In fact, sequentially things, because of the holiday effect, should only look up.
No, not really. See, what happens is, okay, first on the guidance part, it factors in a minus 0.4 to 1.4% growth. So it does factor in a 1.4% growth on upper end. But also what happens in 4th quarter, because of February being a shorter month, you have lesser working days. So the working days are almost equal to what you have in Q3. It's slightly lesser than Q3 to that extent. Also, it's the start of the budgeting cycle for the client. So you have to have the budgets getting close to the client then it's translating into contracts, SOWs, and then executing. So there is always a lag in getting orders in the first 1 or 2 months. So it's very unpredictable 4th quarter usually, and that's the reason seasonally these are considered to be weak quarters in the IT industry.